Welcome, ladies and gentlemen, to segment number 6 of P3, the Cima SES Complete Essentials Revision. This segment is on internal controls. Let's have a look. Before I get started, a quick reminder on my kind suggestions. Please have a notebook and pen on the ready. Follow the slides and my explanation carefully. Make the notes as you deem necessary. Maintain a list of key topics that you feel you're weak at so you can self-revise later. And please maintain a list of key performance and management tools that can help model answers in the strategic case study. A quick reminder of the core activities. Co-activity D is on evaluating and mitigating risk, and co-activity E is on recommending and maintaining a sound control environment. In fact, this particular segment is a very important segment on internal controls, directly relates to co-activity D, recommending internal controls, and a subset of co-activity E, maintaining a sound control environment. So we are going to basically learn how important internal controls are, what kind of internal controls can we implement in a company, and the kind of protections that it puts in place to ensure that an organization is run sustainably. All right, let's take a look. So to get started with, we have to try and understand what internal controls mean. A definition among many. Internal controls are the whole system of controls, financial and otherwise, established by the management in order to carry out the business of the enterprise in an orderly and efficient manner, ensure adherence to management policies, safeguard the assets, prevent and detect fraud and error, and secure as far as possible the completeness and accuracy of the records. So it's a complete system, both financial and otherwise, established by the management, which is supposedly, which is basically supposed to take care of so many things in terms of management policy, asset safeguarding, fraud detection and prevention, and security and maintenance of records. So it's a very integral part of a company. Internal controls can be considered as part of the risk reduction method of responding to risk, and the need for a robust system of internal control and risk management is seen as a major element of good corporate governance. Now, in fact, if you take a look at the syllabus, the content of the internal control section and partly the corporate governance segment also, you will notice that the strategic level syllabus for this particular section is based on the recommendation of IFRC's internal control revised guidance for directors on the combined code extract of the or rather of the well-renowned Turnbull report. So in fact, if you look at the syllabus, we could say that your syllabus is an extract from the Turnbull report. All right, so next we are looking at the importance of internal controls. There are fundamental importances. Even when I started, this is actually an area that I'm personally heavily invested in. I believe that controls are essential, especially as a company grows, and the more people that you add, the more resources you have to manage, the importance of controls becomes greater and greater. Internal controls play a key role in the management of risks that are significant to the fulfillment of its business objectives. It facilitates the effectiveness and efficiency of the operations. It helps ensure the reliability of internal and external reporting and assists compliance with laws and regulations. And it also helps ensure that the company is not unnecessarily exposed to avoidable financial risks, and that financial information used within the business and for publication is reliable. Depends on a thorough and regular evaluation of the nature and extent of the risks to which the company is exposed. It also sets appropriate policies on internal control for the board of directors to enforce and seek regular reassurance that will enable it to satisfy itself that the system is functioning effectively. So this is where you see that collaborative effort between the risk management team, internal audit, and the internal controls you put in place. All staff collectively should have the necessary knowledge, skills, information, and authority to establish, operate, and monitor the system of internal control. So please pay attention here. Establish, operate, and monitor. It's not only one of those. All the staff should have the skills to establish, come up with internal controls, operate them, stick to them, follow them, and monitor them when needed. It will be embedded in the operations of the company and form part of its culture. And normally, internal controls reduce, not eliminate, the possibility of poor judgment in decision making, human error, control processes being deliberately circumvented by employees and others, management overriding controls, and the occurrence of unforeseeable circumstances. So this is how important internal controls are for a company. All right, next, what is the expectation surrounding internal controls? We are going to basically understand it in two ways. One is what it can do, and the other is what it cannot do. So as far as internal controls, or what internal controls can accomplish, is that it is a sound system, or rather a sound system of internal controls provides reasonable but not absolute assurance that a company will not be hindered in achieving its business objectives or in the orderly and legitimate conduct of its business by circumstances which may reasonably be foreseen. But what it cannot do is that a system of internal controls cannot, however, provide protection with certainty against a company failing to meet its business objectives or all kinds of material errors, losses, fraud, or breaches of laws or regulations. That it cannot do. It cannot eliminate, and it cannot completely protect. It's a way of mitigating and facing and ensuring your business can resiliently conduct itself. That is very important, because we have to be very clear as to when we impose controls over a company, the extent to which it can safeguard us. All right. Next, we are looking at features of internal control systems. Now, as you know, the COSO framework, according to the same group of individuals who proposed the COSO framework, an effective internal control system consists of 5 integrated elements. The first one is control environment. That is management's attitude, actions, and awareness of the need for internal controls. If senior management do not care about internal controls and feel that it is not worthwhile introducing internal controls, then the control system tends to be weak. The second one is risk assessment. A risk assessment must be performed and should identify controllable risks and uncontrollable risks. For controllable risks, you can set up internal control procedures, whereas for uncontrollable risks, you'll have to minimize it in other ways, especially if they are outside your control and external to the company. Third is control activities. A variety of different control processes to ensure that the business achieves its objectives that can be put in place. So basically having a defined organizational structure, contracts of employment, establishing policies and procedures, a suitable discipline and reward system, performance appraisal systems and feedback. All of these are control activities. The fourth is information and communication. So information is critical, and therefore a good information system must be set up that provides timely, accurate, understandable, and relevant information. Finally, monitoring. If the system is not monitored, it will be very difficult to assess whether it is out of control and needs amendment. So the internal audit function, which we will look at in a different segment, is the key monitor of the internal control system. Internal auditors will examine the controls and the control system, identify where controls have failed so that the failures can be rectified, and also make recommendations to management for new and improved systems. So please remember the 5 key features of internal control systems control environment, risk assessment, control activities, information and communication, and monitoring. On that note, we can look at the principles of the internal control systems. So actually it's very closely connected to the features themselves. Let's take a look at the fundamental principles underlying each of these features. Now, with the control environment, the organization shows a commitment to ethical values. If you have a sound control environment, and the board has appropriate expertise and oversees the 5 competencies. Management must establish an appropriate organizational structure to help achievement of the objectives. Human resource policies and practices to help attract, develop, and retain suitable talent. Accountability of employees for their areas of responsibility. So if you have an internal control system, a sound internal control system, one of the aspects is it means that you have a sound control environment, and if the principles that are provided here are what embodies or what indicates that you have a sound control environment. If any of these principles are weak, then you're basically your control environment is lacking in terms of its strength. Let's look at risk assessment. As far as risk assessment is concerned, it will have clear objectives to allow risk identification and assessment. That risk identification and analysis does take place across the entity. The potential for fraud arising in pursuit of the stated objectives also are considered. The internal control system must be reviewed for changes in the external environment. So you're basically talking about how important internal controls are in the initial stages of risk management strategy, because risk assessment is one of the first and foremost activities you undertake when you're developing risk management strategy. At that place itself, you are able to commit to sound principles of internal control systems. Thirdly, let's look at the control activities. So here you get to select appropriate controls to mitigate the risks to the achievement of objectives. Specifically, you can have controls over tech. Policies and procedures are established as to how the controls are implemented. Fourthly, information and communication. Appropriate information is generated and used to assess controls. The information is communicated appropriately internally to support the internal process. The information is communicated to appropriate external parties as well, based on various publications and the kind of requirements. And finally, monitoring. Appropriate evaluations of the controls. The final evaluations of the controls are carried out. Obviously, internal audit can play a key role there. Any issues with controls are communicated to appropriate people, including the board where necessary. That is the discussion on the principles that will embody within the 5 key features of the internal control system. So please remember these 5 elements and and the principles that are embedded when the 5 elements are strong and they're really good. Because when you are doing a question, what you have to evaluate is you have to read your case and see if there are weak points. There are things that compromise these principles. If so, you have a point of weakness that you could capitalize on when you're writing your answer. On that note, let's take a look at the operational features of internal control systems. So basically, if you sum it up, you sum everything up, because now you know the features, you know the principles. These are the 3 key characteristics, traits that will define sound internal control system. 1, it will be embedded within operations and not treated as a separate exercise. 2, it would be able to respond to changing risks within and outside the company. And 3, it would include procedures for reporting control failings or weaknesses. So please make a point of these three characteristics. This is what characterizes a sound operational internal control system. It is part and parcel of the company, is embedded, it is able to respond for internal external changes very effectively, can adapt, and it has procedures for reporting whenever there are failings, there are signals, there are red flags, there is proper communication embedded. If something goes wrong, it is immediately communicated to the right person as soon as possible. These are what defines a sound internal control system. Now let's take a look at a few examples of specific organizational controls. These are some very common examples that the moment you see them, you will realize, oh right, even though it looks like an operational element, no, it's actually a control. Segregation of duties. Most accounting transactions can be broken down into three separate duties: authorization or initiation of the transaction, the handling of the asset, that is the subject of the transaction, and the recording of that transaction. So this reduces the risk of fraud and the risk of error when you segregate these three among different individuals. Physical controls. Physical controls are measures and procedures to protect physical assets against theft or unauthorized access and use. Authorization and approval. These are established to ensure that a transaction must not proceed unless an authorized individual has given his approval, possibly in writing, because you want to document everything. Next, management control. Controls are exercised by management on the basis of information they receive, either through top level reviews, these are senior management reviews, or activity controls, these are departmental, divisional, or functional level reviews. Supervision, basically oversight of the work of other individuals by someone in a position of responsibility. Organization, controls provided by the organization's structure, like reporting lines, divisional segregations, etc. Arithmetic and accounting, that is basically recording, checking, and verifying transactions. Personnel controls, recruitment to resignations, dismissals, and suitable induction and training to ensure employees are of best fit to the organization and retain the quality of the company. So these are some simple examples for you to easily capture what organizational controls could be. Right. So we have a simple mnemonic to easily remember the common and widely popular forms of controls. You would have already heard it, I'm sure. So just a quick reminder, as you know, it's SOAP SPAM, supervision, organization, arithmetic and accounting, personnel, segregation of duties, physical, authorization and approval, and management controls. You have supervision controls, organizational controls, arithmetic and accounting controls, personnel controls, duty segregation, physical controls, authority and approval controls, management controls. If you remember these 8 key words, or even if you remember SOAP SPAM as a mnemonic, that would be very easy if ever comes the chance for you to come up with, for you to suggest various internal controls to a particular company or a variant, or in your real life, if ever that opportunity arises. Brilliant. Next, we look at categories of controls. There are mainly 3. Firstly, we have financial controls. So these are very common because you want to control the financial, the transactions, and you want to, limit any kind of fraudulent or any kind of, poor behavior around financials. So express financial targets and spending limits like budgetary controls, working capital limits, bank controls, cash controls, etc. Then you have non-financial quantitative controls and non-financial qualitative controls. So if you look at the quantitative non-financial controls, the focus is on non-financial targets against which performance can be measured and monitored because they are quantitative in nature, like the BSc balance scorecard targets, ISO standard targets, customer satisfaction level targets, quality level targets, but you have to define, you have to come up with a measured definition to the level that you want to achieve. Then you have non-financial qualitative controls. These are the day-to-day controls over most employees in organizations, such as employee training, contracts of employment, physical controls, project management, timelines, Gantt charts, all that. Those are non-financial qualitative controls. Next, we arrive at evaluation of an internal control system. Firstly, and one of the most fundamental aspects is you need to ensure that the adequacy of the system is checked. How do you do that? You can ascertain the objectives of the system in question. Research should be conducted regarding the current systems in place. Inputs to the process should be identified. Comparators can be used. New controls must be implemented when inadequacies are noticed. Then cost versus benefit. As normal with any organizational system, the benefits, that is risk reduction and objective achievement, must outweigh the costs. That is time, implementation, maintenance, training. So your purpose of having sound internal control is to reduce your risk and achieve your objectives. That benefit must far outweigh the costs and the effort and the resources that you allocate to set this up. Signaling over limitations like over-reliance, failures, potential inaccuracies must be raised. Right? Signaling, communication is very, very important. So you have to, when you're doing an evaluation, you need to check those limitations. Transparency, helping duty holders to understand what is expected of them and what they should expect from the enforcing authorities, and investigations to uncover any shortcomings. Prosecution of individuals, identifying and prosecuting or recommending prosecution of individuals if they consider that a prosecution is warranted. And so you have to keep an eye out for any kind of individuals who go off track, and it must enable the prosecution in such cases. Other factors like publicity of convictions, actions by courts, and death at work, etc., must be looked at when you are evaluating an internal control system. Then we arrive at limitations of internal control systems. Now, obviously, we started by looking at what it cannot do. Remember the expectation slide? So it is closely connected, the limitations. There are few realities with respect to internal controls that must be accepted. A good internal control system cannot turn a poor manager into a good one. And the system can only provide reasonable assurance regarding the achievement of objectives, where all internal control systems are at risk from mistakes or errors. So deliberate, no, sure, we want to stop deliberate attempts, but mistakes and errors, this will be prone. Human errors. Internal control systems can be bypassed by collusion and management override. And so there is always going to be some powerful individuals who have the freedom to bypass certain controls, and in such cases, it is a limitation. Controls are only designed to cope with routine transactions and events. There is another aspect, because one-off incidents, any sudden projects that you undertake, you might commit to a particular client's job, and really it's a very unique thing. Therefore, you haven't really had the time to set up internal controls, and that could even be drastic if these projects are big. There are resource constraints in provision of internal control systems, limiting their effectiveness. That is another concern that you can have, where you don't have the sufficient amount of resources to deploy to ensure your internal control system is sound. Right. So with that, we transition to another sort of this deliberate sabotaging aspect of internal controls, which is commonly known as fraud. Fraud is, most importantly, we have to understand, it's intentional and it is a crime. So fraud is intentional and is a crime. The definition for fraud stands dishonestly obtaining an advantage avoiding an obligation or causing a loss to another party. Distinction against error. Fraud is deliberate falsification, while errors are unintentional mistakes. For example, the theft of cash or other assets, false accounting, crimes against consumers or clients, investors, government, employee fraud against employers, etc. Why do we discuss fraud in an internal control segment? You know why? Because if you look at the WorldCom incident, if you look at the Enron incident, if you look at the collateral, the subprime mortgage crisis, even if there were effective internal controls, and if the people who were involved in those operations were vigilant and they actually took the time to ensure the establishment, operation and the monitoring of internal controls, establishing, operating and monitoring. The people of that company are invested in all those aspects, then you've got a very sound system. But if you look at the Enron incident, if you look at the WorldCom incident, if you look at the CDO incident, all of these are situations where there was fraudulent behavior, intentional and deliberate. That is why, in the first place, why we have corporate governance. You looked at it in the previous segment. The reason why we have corporate governance and the Turnbull report to come in and the COSO framework, to be established and proposed, all of this was because there were no internal controls. Actually, it's a funny thing. If people, now you form a company with people, if the people behave right, you don't need internal controls. So ethics is where things start. If people were ethical, they wouldn't do mistakes or errors, like mistakes and errors, sure, but they wouldn't do fraud. Then you don't need internal controls. But because it's not that simple, companies needed internal controls to ensure that things didn't go wrong. What happened was when the industrial revolution and this economic boom happened, I'm talking post World War II, up to the 1980s, 1990s, companies grew and the banks grew and the corporate sector grew, but there was no internal controls. So people used to do what they wanted. Ultimately, by the 1970s and 80s and the late 20th century, things had gone so bad that the lack of internal controls was noticed. That is how corporate governance and the COSO framework and the five features of internal control environments were all established. So, on that note, we can move to prerequisites for fraud. Dishonesty on the part of the perpetrator. So, honest people or honest individuals might not get into fraudulent behavior, but dishonesty on the part of the perpetrator. Opportunity for fraud to occur. There is an opportunity, and internal control can play an active role there to mitigate, to eliminate those opportunities. Motive for fraud, that is where the intention comes in. Indicators. Warning signs and fraud alerts are potential indicators. Warning signs mean organizational indicators of fraud risk. Fraud alerts are specific events or red flags which may be indicative of fraud. Then, how do we manage fraud risk? Fraud risk management. Embedded within the risk management strategy, we can say that fraud risk management strategy has 3 elements in it. 1. Fraud prevention. Main focus by active management commitment and promoting an ethical culture to prevent fraud. Fraud detection through regular checks, signals, red flags, whistleblowers, etc. Fraud response. Arrangements for dealing with suspected cases of fraud, theft or corruption, internal disciplinary action, civil litigation, criminal prosecution, etc. So having that proper system of justice implemented within the company, outside the company, as fraud response. These, when effective, lead to risk deterrence, and the process operates within the wider context of the organization's risk management strategy, as I said, corporate governance and ethical culture, while the legal aspects of fraud are also addressed. So as you can see here, a good summary image where the wider aspect of legislation, risk management, corporate governance, and ethical culture are there, and within which you have prevention, detection, and response embedded, ultimately leading to effective deterrence of fraud. This is what technically one of the key jobs of internal control. On that note, we mark the end of this segment. Very interesting segment, very critical segment, but also very simple segment. It's easy to understand, but very, very important. As we find normally in life, it is the simplest matters that are of the most importance. Internal controls are a good example for that. So in this section, we looked at features of internal controls like the COSO elements, the 5 elements, and the operational features for a sound internal control system. We looked at the details of controls like control activities, scope, spam, etc. Accounting controls, these are the general controls. The financials like sales, working capital management controls. And the classifications, the 3 classifications: financial, non-financial, quantitative, and non-financial, qualitative. And on the latter end of things, we looked at evaluating internal control systems and limitations of internal control systems. And finally, we looked at fraud, understanding fraud, what fraud is, what leads to fraud, and how do you respond to fraud, or how do you manage fraud risk. On that note, yes, do keep learning and enjoy the process as usual. Hope the segment was quite informative and quite useful. A very important segment, as I mentioned. Happy learning, ladies, gentlemen, and thank you.